Not only is cash rate at a historic low at 1.75%, also the bond yield curve is at lows as well. That's reflecting globally yields are going to, cash rates and yields are going to be lower for longer. And that means investors are searching for some form of extra yield and return from their money and their investments. And in a capital stable portfolio, and part of their portfolio, credit and fixed income, the credit is a compelling component of that at the moment. Recent interest rate cuts not only helps stimulate underlying economic activity, which helps corporate credit, it also helps the underlying repayments and creditworthiness of underlying mortgage-backed securities that we're a large holder of across our funds. Because what happens as underlying cash rates decrease, people tend to, in their mortgage repayments, keep their payments the same. So they have more of a capital repayment, and their ongoing payments would stay the same, and the interest rate component is less. So that improves the creditworthiness of those securities as well. The volatility in this year's market's been a good reminder that the best way to extract value from credit is to be active. So the idea is to hold a diversified portfolio of securities, so not a select number, but have a well-diversified portfolio in terms of number of underlying credits, and also to actively manage that in the environment. So when the outlook's negative for credit, is to de-risk or become more defensive in your portfolio, and when you're positive, the credit markets become more fully invested and become not necessarily aggressive, but become more fully invested and use the whole spectrum of credit, whether up and down the capital structure, ratings bands, or increased tenor and credit. And that means that you can, when the environment's negative, you can reduce the potential for capital losses through spread widening. But when it's positive, you can increase the chances of participating in credit spread tightening, the capital gains that are associated with that. So for instance, this year across our portfolios, we bought some positions in bonds which we didn't buy last year or that were too expensive. For instance, the Apple bond, which is one of the largest bonds issued in the Australian market last year. We didn't buy that at the time because it was too expensive. But in some of our funds this year, it got cheaper than it was issued at, and we bought it, and it's got a bit shorter now, so it's a defensive asset class. It's quite a strong credit, despite some volatility in the equity price for that name. But the credit fundamentals for that name are strong, and it got quite cheap, so we bought some of that. We still like the credit fundamentals of the banks. They're still well rated. They're still implementing regulatory strengthening things for their credit due to the bank oversight from APRA and globally. So this whole re-strengthening of bank funding and balance sheets globally has been a positive for credit investors. And with the recent widening credit spreads and now turning positive, we've taken that opportunity to buy bank senior paper and bank subordinated paper down the capital structure across our funds at spread levels that are 50% wider or 20, 30 basis points wider than they were 6 months ago. So it's been a great environment for investors, and the outlook looks very strong.